Good morning. It's 5 a.m. in New York City, 10 a.m. in London. I'm Matt Miller in for Vonnie Quinn with your Bloomberg Brief. Let's get you set up for the trading day. Jobs report on deck as the AI trade loses steam and stocks head for their first weekly loss since March. Nvidia greenlights 3 of the world's biggest chip makers to supply high bandwidth memory to its AI accelerators, and Elon Musk captivates investors at a JP Morgan SpaceX event ahead of the largest IPO in history, set to start trading next week. Let's get a check on markets around the world. We start off in Asia with Winnie Su in Singapore. Winnie, what have you got?
Good morning, Matt. We are seeing further weakness in Asian stocks today as the AI rally takes a breather and also as investors rotate away from technology shares. And you're looking at the MSCI Asia here down 1.7%, headed for its first weekly decline after 2 weeks of gains. And also leading losses today, we have South Korea's Kospi Index closed down 5.5% with the won also weakening for a 5th session. Now, it really is that foreign selling of South Korean stocks now taking up to as much as $10 billion in just 1 week, weighing on the currency. Now, flip the board and take a look at where that money is going into, away from technology shares, but going into the likes of Japanese banks, which are rising on the back of the further bets of the Bank of Japan to raise rates later this month, and also some of these Chinese consumer names gaining more attraction now that the stocks are also rotating away from technology shares.
All right, Winnie, thanks very much for that. Let's get a look now at what's going on in Europe. For that, we go to London and Justina Lee. Justina?
Good morning, Matt. Now, I always say European stocks are all about oil, but today is actually also reflecting a bit of that weakness in the AI trade. Now, we had the stocks Europe 600 kind of trading a bit flat because it's really being dragged down by kind of the worst performing sector of all. Of course, that is tech, kind of down like almost 2% here in Europe today. And now when it comes to oil, that is slipping a little bit today, and that's being reflected in some of those short end bond yields kind of coming down. Now, of course, when it comes to fixed income and currency, all eyes will be on the ECB next week. Now, Bloomberg just released their survey of the Economist today, and what we're seeing here is everyone's pretty sure we're going to get a rate hike coming up. But what about the rest of the year? Now, if we flip the board here and we look at what money markets are pricing in terms of where the rate will be by year end, and we can see it's kind of around 60 basis points higher, showing that markets are expecting another rate hike coming up this year, possibly around September, according to the survey today. But kind of we'll have to see what ECB officials are going to say next week.
All right, Justina, thanks very much for that. Take a look at what's going on in U.S. markets. We see futures that are down across the board. S&P futures off 0.5%. And as I said, we could see the first weekly loss in 10. We closed the week out in the cash trade last week at 75.84. So if we close below that, it'll break our winning streak. NASDAQ futures off more than 1%. We did see a rotation out of tech stocks here yesterday as well into the Dow Jones Industrial Average, which added almost 1,000 points. We'll be watching that old index closely today, and small caps are off 0.6%. For some of the stocks that we're watching, the individual stories, let's go out to London again for Chloe Melee. Chloe?
Good morning, Matt. We are seeing those AI-related stocks continue on their downward trajectory. Of course, we had that weakness yesterday on the back of this disappointing outlook from Broadcom. And today we are continuing to see this enthusiasm around the AI trade waning a bit and those expectations getting reset. And so we are seeing those 3 here on the board, but in particular, Micron down about 3.5% this morning. Moving on to the retail space, and we've got Lululemon shares sinking this morning after cutting its revenue guidance, and in particular, flagging a poor performance in North America. It has been dealing with much higher competition from new entrants, and also, of course, this weaker consumer spending that we have been talking about for retailers. And so now there's really piles pressure onto the incoming CEO that is going to have to really try and revitalize this struggling company. And so we're down about 12% this morning. And finally, we are also in the red for DocuSign after the company issued an outlook that was seen as a bit disappointing. A lot of analysts are saying this is very much a wait-and-see story with that company, especially when it comes to its new AI-powered platform. And so we are seeing a bit of weakness there in those shares, down about 5% for DocuSign this morning.
All right, Chloe, thanks very much for that. Chloe Melee with a look at your single stock stories. Coming up in this hour, we're going to count down to the payrolls report with Veronica Clark of Citi. Very much looking forward to that. Let's get a preview of those jobs numbers. For that, we go to Ven Ram in London. So, Ven, what are we expecting today, and what are the whisper numbers?
Morning, Matt. I think that the markets are expecting about 85K, give or take. But I think that for the Fed, I think that this is proof of sufficiency that the economy is resilient. And I think that, the markets are kind of underpricing the risk that the Fed could turn hawkish in the short term. In March, you will remember, Matt, that they forecast core PCE of 2.7% for this year, and they projected growth real GDP growth of 2.4%. Now, given the resilience in the economy, I think that, we could get an upward revision next week to 2.5% in real GDP, and we could also get an upwardly revised number for the core PCE, because 2.7% looks rather outdated in the scheme of things, given the global energy shock. So I think that, the two-year Treasury yields are bobbing around 4.05, but I think that the risks are higher for yields, because I think that the Fed can't hold the rate at the current level. Even if they're going to be patient for a bit, I think eventually they'll have to raise rates.
I'm looking, by the way, on the Bloomberg terminal, you type WHIS GO, and you can put in your guess, participate with your colleagues on Wall Street. The survey number is considerably lower than the whisper number, which is now 100,000 and climbing. So we'll be watching that closely, Ven. I wonder, what is the bearish argument against this AI mania in markets that have pushed us to record high after record high? Because valuations don't seem terribly high on a forward PE basis. Is it more of a CapEx issue?
Well, part of it is the CapEx issue, right, Matt? But I think there is also the valuation. So overall, the market may not look, market valuations, aggregate market valuations may not look demanding. But if you look at the NASDAQ 100 components, for instance, fully half of the 100 basket is trading at a PE of 30 times over. So I don't think that's a sustainable valuation. I don't think anybody will say those are reasonable valuations. These are levels at which Warren Buffett would be selling, not buying. And for investors who are buying, they need to be absolutely sure that the earnings growth that they are invoicing are going to materialize at some point. So the markets are kind of getting riper and riper with each passing day. We had Broadcom disappoint earlier this week, and you saw the reverberation showing through in Asia and in Europe as well. So the markets are beginning to feel that, look, you know what, this is looking a bit long in the tooth at the moment. So I think that this countenance can continue until we've got these big IPOs, SpaceX and Anthropic and what have you. But I think that after that, it will be a litmus test for the markets. And if someone comes out revising their capex lower, I think then you will have a turning point in the markets.
All right. Ven, thanks so much for joining us. Ven Ram there from the MLive TV. And get his work and the work of his colleagues by typing MLIV GO on your Bloomberg terminal. Let's turn now, back to tech. Nvidia confirms Samsung, SK Hynix, and Micron will be cleared to help supply its AI accelerators as the CEO of Nvidia touches down in Seoul.
All three vendors have been qualified. All three vendors are in production, and they're all racing. They're racing all to support Vera Rubin.
Joining us now is Matt Bloxham of Bloomberg Intelligence. So, is this really still the biggest bottleneck, the high bandwidth memory, even more difficult than power?
I think it's certainly a critical issue, and so for context, this bandwidth, the high bandwidth memory, is required for the next generation of Nvidia product, which is the Vera Rubin, which is designed to kind of support agentic AI workloads, which, in addition to the GPU workload that we've come to know and love with Nvidia, also requires huge amounts of CPU processing power too, which is the Vera part of the offering. And memory is in short supply, and it's critical that Nvidia has enough supply to take that product forward. And so the fact that they've kind of lined up all three suppliers is an encouraging sign for the business as a whole. And clearly, all three of those will inevitably be prioritizing sales to Nvidia over pretty much everybody else. So it's maybe going to have knock-on effects to supply for other parts of the value chain.
Matt, are some Chinese firms like Alibaba, are they going to be able to get hold of these Vera Rubin accelerators, or have they been able to get hold of Blackwell accelerator kits for parts of their business that operate outside of China? For example, if they have servers in Singapore, can they get access to chipsets that are banned for sale in China?
Yeah, I mean, I think the official answer to that would be no. But as you know, we've kind of heard that the US has been looking at whether it's Trump era controls over this high-tech sales of things like Nvidia chips has really been that effective, and certainly some question marks about whether there's some loopholes in that system. I mean, I think clearly the likes of Nvidia kind of play the game and operate as if there aren't loopholes, but I think inevitably there's going to be some leakage of this technology back to kind of Chinese companies, whether that's in China or overseas. You know, we've heard examples of that over the last several months. So I think most of the big firms are acting responsibly, but it's incredibly hard in this kind of global economy with so many different parts of the value chain to have kind of a watertight system. So I would think that inevitably there's a bit of leakage here and there.
All right, Matt, thanks so much for joining us this morning. Matt Bloxham covers tech for us on the Bloomberg Intelligence side out of London. Now let's get to the other top stories trending on the terminal this morning. Banks are curbing staff travel to China as regulators there intensify scrutiny of cross-border investment flows. UBS postponed its mid-year wealth outlook event. HSBC is discouraging non-essential travel to a China-based event. Banks are reassessing their approach on the mainland after Beijing launched its most aggressive campaign yet against unauthorized cross-border trading to stem capital flight. Ukrainian President Volodymyr Zelensky proposes peace talks to Vladimir Putin in a rare open letter. Zelensky wrote, "We in Ukraine do not want a permanent war. We know very well that life without war is infinitely better." The appeal comes as European officials discuss the possibility of holding talks between Russia and Ukraine. U.S.-led peace talks have stalled. Bitcoin's sell-off is putting fresh pressure on digital asset treasury companies. Shares of dozens of firms are extending losses, sometimes exceeding those of the cryptocurrencies they were built to own. Roughly $62 billion in market value has been wiped out since its the October peak of Bitcoin. Coming up, the S&P Dow Jones Indices denies fast entry of mega IPOs, including SpaceX. More on that move next. This is Bloomberg. This is Bloomberg Brief. I'm Matt Miller in New York. The S&P Dow Jones sticking to its eligibility requirements for benchmark indexes like the S&P 500 to fast-track mega-cap IPOs, leaving companies like SpaceX to wait 12 months before they are eligible. Joining us now is Bloomberg's Benedict Campbell. And Benny, I wonder if this, which is really an interesting move, is because S&P doesn't necessarily have to attract these companies for listing.
Well, eventually they do want them, but they're obviously cautious here that they don't want to insert too much volatility into the index. And this is what you get when you get these early entrants. You know, you're not quite sure where they are going to go in terms of their profitability, in terms of sort of the stableness of the business. And if we look at the SpaceX numbers, you know, there are a lot of question marks in terms of the growth trajectory, in terms of the stable delivery of their operations and so on. So what we're hearing now, or what S&P is suggesting, is, you know, we need to sort of preserve some state of normalcy here, you know, in an IPO process that has been everything but normal, from the listing to the price and so on. So this is obviously not great for some of the sort of passive funds that track the IPO, because they track the index. So that means that they will be excluded here. So that's not great. But this is sort of them trying to find a balance, S&P that is, between stability and sort of going after the hype, as it were.
So, I mean, my point is, though, that unlike the NASDAQ or the New York Stock Exchange, they don't operate a business where they make money by attracting the listing, right? They'll want it in their index eventually, but they want it to be seasoned first. Because if you look at a history of giant IPOs, the average drawdown from peak to trough is 55%. So passive investors could easily get burned if a giant stock like this is included so soon after its listing.
And that's exactly right. So that's what they are trying to avoid. They are trying to avoid this level of volatility, the burn that might happen to these passive investors. And they're saying, let's give it a year. Let's sort of not throw some of our requirements to the wind. And that's why they've added sort of, or why they've kept to their principle and say, let's add it a year later, see how it settles, and then let's do it.
In terms of the profitability requirement, is that something that they're also keeping? Because SpaceX isn't expected to make money until at least the next decade.
Well, yeah. I mean, if you look at the SpaceX outlook, it is it's not particularly stable in terms of what they will bring in. They have a huge addressable market for sure, 28 trillion. But then the profitability, as you say, is lacking behind that. So this is a business that is not profitable. They had billions in losses. The revenue is broadly in line with the losses. So again, this is something that they will take a close look at and see how this develops. You know, if you look at the prospectus, and if you look at what's being marketed, huge growth prospects here for the revenue side, for instance. This is a business that the bankers say can grow in the next couple of years to 500 billion in revenue. Now, if you look around, there aren't that many companies out there that have that kind of revenue. The likes of Amazon, of Walmart, maybe. Even Apple is quite a bit below that. So there's obviously a huge delta between where SpaceX is now and where they want to be in a couple of years. And that is sort of the volatility that we're talking about. Can they actually achieve that? How will they do so? This is somewhat a conglomerate business. We have the space business, the launcher business, the satellite business, and then sort of superimposed onto that, we have the massive AI business where, you know, all bets are off how profitable that might be. For now, it's consuming huge amounts of cash. So that is really sort of the delta here and sort of the unsure part, and that's why I think there is that volatility.
All right, Benny, thanks very much. Benedict Camel joining us out of London. This is Bloomberg. When Rodrigo Paz was elected president of Bolivia, it marked a major shift following 2 decades of socialist rule. Wall Street Week traveled to the country to see firsthand his mandate of economic reform, including tapping into the country's vast lithium resources.
The Salar de Uyuni in Bolivia is the country's crown jewel. It's a sprawling salt flat on the Andean Altiplano. So large, it's visible from space.
We are at 3,650 meters above sea level, my friend.
Very high.
Very high. So the lithium mining just down on the south. Okay.
We're standing on top of one of the largest lithium resources in the world.
La pregunta es, ¿por qué queremos ser pobres?
After he was elected last October, President Paz signaled Bolivia is open for business. But as we discovered, there is a disconnect between his rhetoric and the realities on the ground. We arrived in La Paz to sit down with the president as violent protests erupted across the country, shut down parts of the city.
Everybody knows the Bolivia story. It's an incredibly, commodity-wise, it's kind of hard not to see it as a really easy place to make money. It's just the sort of the ethnic tensions there that have always existed. And the fact that they have a tradition of going out in the streets, there's been a lot of turnover of governments. And as we're seeing now, it's pretty easy to sort of choke the economy.
Bloomberg's Simon Hampton joins us now at the desk. So, Simon, Bolivia has been talking about its lithium potential for decades, as David says. What makes it different this time?
Well, I think Paz is really trying to engage in US investors this time, and he's forged close relationships with the Trump administration. We saw just yesterday even support from Marco Rubio, the Secretary of State, and Pete Hegseth, the Defense Secretary, throwing their support behind the administration in the face of some of the protests that we've seen down there. But I think he's trying to engage in US investors. He's trying to change the investment structure in Bolivia as well, and make it more attractive for foreign investment. I think some of the challenges that foreign companies faced going into Bolivia was that the state wanted a big cut of whatever extraction happened down there, and it didn't really make it a particularly attractive investment for foreign companies. You couple that with the fact that Bolivia is a very remote place. Most of La Paz, the capital, is at altitude around 14,000 feet. The Salar de Uyuni, which you saw in that clip, is also at a similar altitude. It's quite hard to get the resources out of Bolivia as well. So there's some, it's very capital intensive, and then the sort of investment climate there has also been pretty challenging for investors.
All right, well, we look forward to seeing this episode of Wall Street Week. Simon Hampton produced that for us, and you can watch Wall Street Week every Friday at 6 p.m. Eastern. Definitely an episode you want to tune into tonight. Coming up, we're going to push ahead to the payrolls report with Veronica Clark of Citi next. Will this drive interest rate increases? This is Bloomberg. It is 5:30 in New York City, 10:30 a.m. in London. Good morning. I'm Matt Miller in for Vonnie Quinn with your Bloomberg Brief. Let's get you set up for the day. The jobs report is on deck as the AI trade loses steam and stocks head for their first weekly loss since March. Nvidia greenlights 3 of the world's biggest chip makers to supply high-bandwidth memory to its AI accelerators, and Elon Musk captivates investors at a J.P. Morgan SpaceX event ahead of the largest IPO in history, set to start trading next week. Let's get a look at what's going on in stocks. S&P futures are down, and we see NASDAQ futures off more than 1% now. We could break our weekly winning streak. A weekly loss is possible for the first time since March. Take a look at what's going on in treasuries as we have seen yields coming down. They continue to fall. The U.S. 2-year yield at 4.03, the 10-year at 4.46, 4.47, and the long bond trading at 4.97.15. For some of the stocks that we're watching for you, let's get over to Chloe Melee in London. Chloe?
Good morning, Matt. We're seeing those AI-related stocks extending losses in pre-market trading this morning. We, of course, had a lot of weakness yesterday on the back of Broadcom's disappointing outlook, and we're seeing this enthusiasm around the AI story, around the AI trade, weakening a little bit, and some of those expectations getting reset. And so we're seeing Nvidia, Micron, and Broadcom all down this morning, and Micron in particular in the red. Moving on to another company that's in the red, and that is Lululemon, which has cut its revenue guidance, and that is really leading the shares down. This is a company that's dealing with a lot of different challenges. There's, of course, the weaker consumer spending that we've been talking about, higher competition, but also some recent product blunders like the see-through leggings that we remember from a few months ago. And so now this really is piling pressure on the incoming CEO to revive demand for that company. And finally, DocuSign is also in the red this morning, seeing a bit of weakness after guidance underwhelmed investors. And analysts are saying that now the company has to prove that this AI-powered platform that it has developed can really accelerate that demand and that growth going forward. But in the meantime, there's a bit of weakness there, and we're down about 3.4% in pre-market trading for DocuSign.
All right, Chloe, thanks very much for that. Chloe Melee with a look at some of the individual stocks we're following for you today. Now, less than 3 hours until the payrolls report is released. The whisper number currently at 100,000 jobs added in the month of May. This will be the last print ahead of Fed Chair Kevin Warsh's first rate decision at the Post. Joining us on the desk is Veronica Clark, U.S. economist for Citi. So, Veronica, looks pretty good, this labor market. I mean, I think a lot of people had expected AI to wipe out jobs, and we really haven't seen that yet.
No, we haven't. There has been some increase in the layoff rate in the information sector. That's some of those tech companies. But yeah, as a whole, the labor market the last couple of months looks pretty stable. I think we'll see that again this morning. We're looking for 60,000 jobs. That's still very healthy, a stable unemployment rate. But I would say the stability looks pretty fragile. This is still this very low hiring, low firing environment. And what we have seen the last couple years is that it does look stable until you maybe get to the summer and you get students looking for work, new graduates, things like that. And this low hiring rate does tend to push the unemployment rate higher in the summer.
So do you expect the jobs picture to get much weaker this summer?
Yeah, I do think we will see that. So yeah, we have this stability right now, but some of the forward-looking indicators don't look particularly encouraging. Yesterday we got the NFIB small business hiring plans. We'll get the full data for that survey next week. But those hiring plans broke through the lows of the last couple years. They do tend to lead payrolls by a couple months. They're not quite at pandemic lows, of course, but trending in the wrong direction.
Pandemic lows should be the outlier.
Yeah,
right?
but a lot of data honestly look like pandemic lows, the hiring rate and things like that. So yeah, it doesn't really feel like a very comfortable labor market still.
So, but it's not going to be an environment in which Kevin Warsh finds it easy to cut rates. And we imagine, I guess we assume that that's his mandate, although he says President Trump has not asked him to do that. This administration is really pushing for lower rates. Will they get it?
Yeah, not right away, of course. Yeah, it's going to come in a couple weeks, and it's going to be really hard to be too dovish, especially because the market might perceive you're not taking the inflation risk seriously. And we will get inflation data next week. I think core PCE in May, when we add up all the details, will still be pretty uncomfortably strong. So yeah, he won't be able to sound too dovish next week. But I think later in the year, yeah, if we see the weakness in the labor market reemerge, the underlying drivers of inflation that the Fed would care about most, things like the labor market being too tight and home prices rising too strong, that's really not a driver of inflation right now. So they might be able to kind of massage what inflation they look at for an underlying trend.
How seriously does this Fed take inflation pressures? Because we're still looking at PCE that's almost twice their stated target. And remember that they want to average 2%, not just touch it.
Yeah, we've kind of given up on that averaging. I think we've been well over 2%.
Have they given up on that?
I think a bit. We've been well over 2% for a while now, of course, but we were undershooting 2% pre-pandemic. Yeah, there will be a debate, I think, on, we're already starting to hear this from Fed officials. Obviously, some are more hawkish than others, but what type of inflation measure do you look at? We're hearing more about these trimmed mean kind of inflation measures. That was came up in Warsh's testimony in the Senate a month or so ago. What's the right way to look at the underlying trend? Because there are different data that are telling us different things right now. Core CPI is much softer than core PC, which is somewhat abnormal. So what's the right way to look at inflation?
What does the consumer look like? I mean, we hear so much about the K-shaped economy, but they keep spending.
They do, yeah. Consumer sentiment always comes out every month, at recent lows, new lows, but people do seem to keep spending. I mean, that's been part of the story recently. Yeah, spending data does still look strong. You do have the issue now, though, with the rise in gas prices and some slowing in income growth, that real income is negative on an annual basis. There's maybe some subsidy kind of dropping out of that data, but it does seem like there's reasons to think consumption would be slowing.
I guess the big picture question is, how does AI affect not only productivity, but hiring, right? The question is, does it erase like back office jobs, or like Reid Hoffman's famous radiologist example, does it create even more jobs than we may have expected?
Yeah, both could be true. What we see in the data right now, it's kind of hard to pick any single narrative. We got the Challenger job cut announcements yesterday. They're not concerningly high or anything, but AI is cited.
Almost 100,000, right?
Yeah. Relative to the history, though, that's somewhat normal, recent history at least. But companies do cite AI increasingly as a reason why they're doing those layoffs, but it's really hard to know, is that because you're getting more productivity from AI, or is it because you've invested so much in AI you need to cut costs elsewhere? Maybe it's a shareholder friendly reason to say that you're having layoffs, you're increasing productivity.
What do you think, though, Veronica, like 10 years out, or 20 years out, what does this do to the U.S. labor market? Is it the technology that finally kills all jobs, or does it, like every other technology in the past, end up building new jobs that we never even thought of?
I think I'm more in the latter camp. So I'm not so concerned about these mass layoffs. If there were to be a sudden surge of layoffs because of AI, I imagine we might get some regulation around it. But yeah, usually over time, new technology does create new jobs. The issues with AI I'm more worried about are any kind of sentiment correction, equity correction, maybe like what we're experiencing this week, because so much of even GDP growth is AI-related investment. It's a big driver of growth right now.
All right, Veronica, great having you here. Thank you so much for joining us. Veronica Clark there from Citi. Let's get to some of the other top stories trending on the terminal this morning. Banks are curbing staff travel to China as regulators intensify scrutiny of cross-border investment flows. UBS postponed its mid-year wealth outlook event. HSBC is discouraging non-essential travel to a China-based event. Banks generally are reassessing their approach on the mainland after Beijing launched its most aggressive campaign yet against unauthorized cross-border trading to stem capital flight. Sell Indonesia sweeps global trading desks. The nation's stocks have tumbled at their fastest pace, and the rupiah has sunk to all-time lows. It's a dramatic turn for commodities-rich Indonesia, which has been a staple allocation in many emerging market portfolios. The stock market there is down 38% from its peak. And Democrat Xavier Becerra is projected to advance in California's governor race. The next question is who will face him in the midterms? Republican Steve Hilton or Democrat Tom Steyer? The race to replace Gavin Newsom has become the most expensive gubernatorial contest in U.S. history. Coming up, debating the U.S.-China tech policy, the Trump administration worries Nvidia's Blackwell chips were sold to China through potential loopholes. More on that next. This is Bloomberg. This is Bloomberg Brief. I'm Matt Miller in New York. Republican opposition to President Trump's foreign policy growing. The House voting to advance Ukraine aid and Russian sanctions with 18 GOP signatures. That's after the chamber voted to halt the U.S. war with Iran earlier this week. Jonathan Tamari of Bloomberg Government joins us from Washington. So, Jonathan, it did look like Republican opposition was growing, but I was watching the Votorama yesterday, and they were unable to pass an amendment that would sort of erase, I guess, his weaponization fund.
Yeah, there were competing arguments there over which approach would work between the Democrats and the Republicans. They did get a majority for a Republican. I'm sorry. Now, let me back up. They were very close to a majority, but the Republican bill required 60 votes to end that weaponization fund. You ended up basically having Democrats and Republicans disputing how to end it, and they weren't able to reach a deal there. So there's still a lot of opposition, but not enough to put it into law.
I thought it would stop the passage of funding for ICE and CBP. That's what it looked like. But they actually passed a $70 billion bill to fund those agencies after months of debate.
Yeah, and that was the issue, is that the Democratic version of this would have basically sent the bill back a few steps and prevented them from passing that $70 billion this week, which Republicans have been eager to do for many weeks now. I mean, this is a topic that unites the Republican Party. It's one of the rare topics that fully unites the party, tougher border enforcement. And they've been trying to get it done. They kept running into roadblocks. The Senate finally got it done. The House is hoping to do it likely next week. And then they're hoping they can move on with the rest of their legislative agenda, because this has jammed them up and eaten up a lot of time for some time now.
I guess there's not going to be funding for a ballroom. Taxpayers won't be footing the bill for that right now?
That is not in this bill. No, that was removed as part of the way for Republicans to kind of keep their party unified, to narrow the focus and keep it just on immigration enforcement.
All right, Jonathan, great having you on the program. Thanks so much for joining us. Jonathan Tamari there from Bloomberg Government, senior Washington reporter from Bloomberg Government. Really appreciate your time. Let's talk here about Nvidia. The CEO, Jensen Huang, confirms that the memory sector's big three, Samsung, SK Hynix, and Micron, have been certified to help supply its AI accelerators.
All three vendors have been qualified. All three vendors are in production, and they're all racing. They're racing all to support Vera Rubin.
Joining us now is Matt Bloxham of Bloomberg Intelligence. So I guess this is a critical a component. Obviously, it's been a bottleneck as well in terms of supply constraints. How does it look going forward, Matt, in terms of getting enough high bandwidth memory to do what Nvidia needs to do?
Yeah, that's right. So the context of this is the Vera Rubin platform, which is their next generation AI platform to support agentic workloads where you need a huge amount of both GPU and CPU processing and a huge amount of high bandwidth memory to support that. And that's where these big three come in. And the big question, as you said, is whether there's enough supply. I think the fact that Nvidia has authorized all three of them to supply is going to, I think, reassure investors that Nvidia is doing everything it can to get as much of this technology as it can, and that may well have negative knock-on effects to other players outside of the Nvidia ecosystem who will also be trying to compete for the supply of those chips, because I'm sure all these players are going to be making sure they can supply as much as Nvidia wants because it's such a big customer.
Matt, how expensive is it for us to be using AI? How much do the hyperscalers subsidize the tokens that are necessary? Because it strikes me that not everyone is really getting a proper return on their investment yet.
Yeah, I mean, my sense is that the pricing that the big hyperscalers offer to both consumers and enterprises includes a profit margin, but obviously balanced against that, they're making huge investments in additional infrastructure to scale. So you've kind of got that blurring of effects. I think if there's a subsidization coming anywhere at the moment, it's from enterprises who are deploying this stuff because they're still in pilot phases. I think most companies are at a point where they're spending more on AI compute than the productivity gains they're getting. And that's a really critical dynamic that needs to shift over the next, say, 12 to 24 months to unlock the next wave of enterprise scale AI investment, because clearly companies aren't going to be just investing in this and taking on more costs without seeing some kind of economic benefit off the back of it. And we haven't really seen that yet. And I think that's the real sticking point.
I feel like I got to use more than $20 worth of tokens every month I must use ChatGPT for hours every day. Anthropic, by the way, calling for an AI sort of arms race pause to let humans take stock of this technology before it develops itself. We had a great interview with Daniela Amoti yesterday.
Yeah, I mean, this kind of flags a really important point for society as a whole, that this technology does have risks of being able to kind of develop itself and create all sorts of unintended consequences. So I think what Anthropic is proposing, in spirit at least, is a great idea. I think in practice that would be almost impossible to implement, but it is a massive policy challenge, and I think it's going to need a lot of the smartest brains on the planet to figure out some guardrails that might actually have some chance of success to allow humans to continue to control the pace and nature of AI development over the next few years.
Matt, great talking with you as usual. Matthew Bloxham covers the technology picture for us out of Bloomberg Intelligence in London. Let's turn now to SpaceX. Elon Musk's business charm on display, reportedly leaving investors starstruck at an event hosted by JP Morgan's Jamie Dimon. Questions about the highly anticipated IPO brushed aside as many investors chose to focus on the bigger picture. Joining us to talk more about it is Benny Camel, and we're getting headlines across, Benny, that some investors won't be able to participate. Chinese and Hong Kong investors are going to be banned from the SpaceX IPO on security concerns. What do we know?
Yeah, so this is hot off the press just now, as you said, a headline crossing there. So some investors won't be able to participate, and this has to do with sort of national security concerns. And it's somewhat in contrast to what we saw over the last decade, where Chinese money was a welcome inflow into a lot of U.S. investments. And obviously now, with tensions between the U.S. and China sort of still high, there is some concern that you don't want too much involvement or scrutiny from the Chinese side. Also, should we say, control via inflows of funds. So a fairly robust response there. And so this is as the banks are marketing the IPO. It's going on right now. We will get the actual listing next week. And as you said, the mood is positively giddy right now. Everybody's trying to get a piece of this pie. Elon Musk has sort of taken a take it or leave it type approach with his one price fits all. Normally there's a range, but he's sort of rewriting the rules and saying 135, that's the price you're going to get. But everybody's marketing this. We have the lead banks in this, Goldman Sachs, Morgan Stanley, but also Jamie Dimon, sort of the elder statesman of the US banking industry, is also playing a direct role in this. Sort of putting his face onto the marketing efforts from JP Morgan. So everybody, as I said, trying to get a piece of this pie, but it just seems that the Chinese and Hong Kong investors will be left out.
What I mean, in an IPO in which everything stands out as shocking. I mean, a $28 trillion total addressable market, for example, in Goldman's initial documents. I'm still blown away by some of these numbers. Evercore ISI says that SpaceX's AI division, which had $3.2 billion in revenue last year, will have $755 billion of revenue in 5 years. That seems insane, right? I mean...
Yes.
Yeah, but they're not alone.
No, it really does.
Yeah, Goldman Sachs says in 4 years it'll be $474 billion worth of revenue. So that's still 100 times more than we're looking at now. How are these analysts coming to these numbers?
Well, it's all about the projection and the opportunity. But you're right. I mean, a lot of these numbers that we have seen are, to use your term, insane. And, 500 billion or north of 500 billion. There are very, very few companies out there that have that kind of revenue. And certainly companies that go from very little. I mean, a quarterly revenue for SpaceX right now is just north of 5 billion. If you leverage that to the annual number, you're talking about 20 billion. 20 billion to 500 and plus. That is a huge leap, even in 4 or 5 years. Right now, I think companies like Walmart, companies like Amazon manage that kind of revenue, but these are long-established, very mature companies. SpaceX is, they obviously have functioning businesses, but there's a huge question mark over their AI efforts. Where is that going? The competitive field is really hard. You've got Anthropic, you have OpenAI. So where will they fit into this, and can they make these numbers? A lot of questions about that.
All right, Benny, thanks very much. Bloomberg managing editor for space and aviation, Benedict Campbell, obviously in Berlin, sitting at a desk that I used to occupy myself. This is Bloomberg. Let's take a look at what's ahead today. The main event is the May jobs report out at 8:30 a.m. New York time. Then Bank of England Governor Andrew Bailey speaks at 2 p.m. Eastern. And looking ahead to the weekend, OPEC ministers gather on Sunday for their first policy meeting since the UAE left the alliance. Plus, check out Bloomberg Money with Tom Keene and Scarlet Food. That premieres today at 12 p.m. noon in New York, 5 p.m. in London.